Is the stock market in a bubble? Hello, everybody. This is StockerFinance. I'm your host, David Scheuer. Make sure to follow me on Twitter at StockerFinance for more information. So recently, we've seen the stock market surging. The NASDAQ has been surging, reaching all-time highs, and the Dow Jones Industrial Average almost fully recovered from its pandemic low there. On top of that, the S&P 500 index has not only recovered, but also seen all-time highs. That's right, not just fully recovered, but an all-time high for the S&P 500 index during this whole pandemic situation. Now, according to most people believe we are in a stock market bubble. And people are not getting the correlation. It doesn't make any sense. How is the economy so bad, but the stock market appears to be surging? You know, my local restaurants are closing, but the stock market's surging. It doesn't make any sense. In fact, 43.8%, according to my survey that I put out on Twitter, believe that the stock market is a bubble. And 25% believe that there's a 50-50 chance. Only tech stocks are a bubble, only 6.3%, and only 25% of people believe that there is not a bubble, and we're not in that. So the majority of people, and this happens, if you just go out and I ask my friends, I ask my family, I ask, random people, other analysts, etc., if the stock market is a bubble, a majority of them do believe that the stock market is a bubble. They say it just doesn't make any sense. How can the economy be in this situation? When I go outside, I see more homeless people, I see more store closures, but the stock market is surging. That doesn't make any sense. It has to be a bubble. In fact, when you go ahead and look at a lot of the labor force data, we see the civilian labor force plummet here. We see the participation rate plummet as well. Then we see the employed for part-time for economic reasons. That's skyrocketed recently. And when we see the civilian unemployment rate, it skyrocketed to just an absurd amount there, nearly 15%. In fact, it's lowered since then, but it's still higher than the peak of the 2008 unemployment rate. And of course, the reasons for unemployment are almost all job losses. However, there's something that a lot of people aren't getting here. And there's kind of a disconnect between people understanding how the stock market works and how the economy works, and how they're very separate things and different indicators and what they track. You see, the mom and pop shops, which you're seeing them close, you're seeing downtown a lot of your favorite store close because they couldn't make it, which to you signals that the economy might be really hurting. However, the stock market's surging. That doesn't make sense to you, because mom and pop shop closures, they're bad for what I call the visual economy. And what I mean by the visual economy is when you literally walk outside and you see what's going around. In a good visual economy, you walk downtown, you walk to your mall or whatever it might be, you see new construction taking place, you see people running around, going to work, hustling. You can just tell, you can feel that there's a lot of economic activity happening. New restaurants are opening up, there's businesses, everyone's selling stuff. It's looking great. However, in a bad visual economy, you go downtown or to wherever your city center might be, etc., just right outside your house, you see more businesses for sale, places for sale, buildings for sale. You see very little construction happening. Perhaps there's a lot more homeless people than usual. Homelessness is on the rise. Drug usage might be on the rise. Crime is probably on the rise as well with that. And that is what I call the bad visual economy. However, mom and pop shop closures, they don't correlate really to the stock market, because simply enough, those closures are not tracked on the stock market indexes. So more mom and pop shop closures actually means less competition. Mom and pop shop closures equals better for large businesses and chains, which are tracked on the indexes. So quickly here, if large businesses and chains have less competition, that means they take more market share, which means their market cap will grow. And that's partly why we're seeing a surge in the stock market, despite your local restaurants and businesses closing. And a lot of people don't get that correlation. Mom and pop shops are not in the indexes. Large businesses and chains are. So if we go ahead and look at this chart here, which is the Dow Jones Industrial Average over time, and this is adjusted for inflation, we can see the Great Depression there on the left. Then we have the savings and loans crisis in the 80s right there in the middle. As we go towards the right of the chart here, you can see the 2000s tech bubble, quickly followed by the 2008 financial crisis, and that little tiny sliver there, that is what recently happened with the pandemic downfall, as I call it. Anyways, if we go ahead and look at the recovery of these, you'll see the Great Depression took nearly 30 years to recover to its all-time high previous before its plummet there. If we look at the savings and loans crisis, it took about a few years as well. The 2008 the 2008 financial crisis, it took about 4 years. Or not the 2008, the 2001 tech bubble took about 8 years, right up until the 2008 financial crisis, which then took 4 years to recover. And then the pandemic plummet, it took almost just a few months to recover, as you've seen. And a lot of people are wondering how that is possible, how it doesn't make sense. And if we see the recovery here in terms of recession length in months, well, we can see that the quick recovery from the 2020 graph compared to the 2001 tech bubble and the 2007 and 8 financial crisis there, it recovered astonishingly quick. So, for example, if I'm going to make this a little clearer for some of you who may not be getting this or may not be connecting the dots here, you notice a lot of restaurants closing in your area. It seems like the economy is falling apart, but the stock market is still chugging along, and that just doesn't make any sense. So the more restaurants that close, well, that's actually better for McDonald's, Burger King, Taco Bell, and others' performance, which are tracked on the indexes. So that means there's less competition for them. On top of this, fast food historically does well during recessions. They also have the cash to sustain a long economic slowdown, whereas small businesses and such don't. And they also operate around the world in multiple economies. So even if their US locations might be hurting, they may be propped up by their locations in other parts of the world where the economy maybe is performing significantly better or is already fully recovered, etc. So even though your town/city seems to be suffering, the stock market continues to climb because it's not tracking those local restaurants, those local shops that are really hurting, whereas all these big chains and companies are really benefiting from the less competition and are taking more market share. Since they have the cash to survive, they can increase advertising, etc., gain more market share. And on top of that, with McDonald's, Burger King, and specifically, these fast food restaurants, people go to these fast food restaurants more during recessions, not less, because it's affordable food. It's cheap food. So are we in a bubble? Well, in my opinion, no. And before you fly out of your seat, go grab your shotgun and go to the comment section to berate me, let's hold up here a second, because me saying no to this is really interesting because simply there is not the connection between this bad visual economy when you go downtown and the stock market. The connection there is really no connection, because if stuff's not tracked in the stock market, it's not going to be represented. So the stock market is exceedingly gaining market share because large companies are really coming out on top during the recession rather than following behind. Now, of course, some have been hurt significantly more than others, such as airlines, etc. But as, especially tech companies, we're seeing this whole situation is very beneficial for them. More people staying home, which means, more companies like fast food, software companies, video games, all benefit from people staying home more, ordering cheap food, playing more video games, staying online more, needing more software for your company, which is now moved out of your downtown office, etc. On top of that, as I said, again, mom and pop shops and these companies, and these small businesses that are really hurting from this, they aren't tracked in the indexes. So the visual economy looks bad. However, when you look at the stock market, it doesn't reflect that because those companies are not tracked on the indexes. But there still is one other situation to consider. The US dollar is becoming weaker. Now, the Fed keeps printing more money, which has caused inflation and a weaker dollar. Now, what does this mean? Well, for the short term, it's actually quite good, which is surprising to a lot of people. It actually allows for foreign investment and trade, which will boost the US economy. What I mean by that is when the US dollar is weaker, especially during times like now, it allows foreign people or foreign companies to go ahead and invest more, buy more shares of a company, because their currency will go farther in the US now than it did before. It was a perfect time for them to take advantage of this, invest in the US, maybe buy US goods, because their currency goes farther in the US now, since the US dollar is weaker against their currency. Now, in the long term, it's actually bad, though. If it keeps becoming weaker, well, US citizens and companies will have less purchasing power throughout the world, which will hurt our economy and our leverage in the world. So anyways, I hope this kind of summarized some stuff, maybe clarified some situations about the stock market for you. Thanks for watching. Please subscribe. We're almost at 1,000 subscribers. Make sure to check out these videos as well. Follow me on Twitter at StockerFinance for more information. And please leave your opinion below. Do you think we're in a stock market bubble or not? What is your opinion on the economy right now and the stock market? Let me know in the comment section below. I really want to hear your opinion. And I'll see you guys in the next video. Peace out.